Welcome to Tesla Daily News Podcast. It's Friday, March 20th, 2026. Today we're tracking 3 things that can actually move Tesla's stock: a stepped-up federal probe into full self-driving, fresh robotaxi competition pressure through a big Uber, Rivian deal, and the broader risk-off tape as oil spikes and markets reprice inflation and rates. Let's get into it. Story 1. The U.S. safety regulator just turned up the heat on Tesla's full self-driving, and this is the most stock-sensitive headline of the day. Here's the hook. NHTSA upgraded its investigation into Tesla's full self-driving, supervised version to an engineering analysis, which is essentially the highest level of scrutiny before potential recall action. Context: Tesla's long-term valuation still carries a big autonomy premium. Elon Musk has repeatedly framed autonomy as the difference between Tesla being worth a lot versus basically zero. So when regulators question real-world performance, especially as Tesla is trying to scale a robotaxi service in Austin, markets pay attention. Details. According to reporting, the probe began in October 2024 and focused on FSD performance in low-visibility conditions. NHTSA says it has now identified 9 crashes tied to these conditions, up from 4 initially reviewed. The agency's memo says that in the crashes it examined, the system did not detect common roadway conditions that impaired camera visibility and did not provide driver alerts with enough time to react, in some cases, not until immediately before impact. NHTSA also notes it has not received all the information it wants from Tesla, including clarity on whether an update Tesla began developing in June 2024 was actually deployed and to which vehicles. Impact. For investors, there are 3 potential knock-on effects. First, recall risk. Even a software recall can be costly in engineering time, can create negative headlines, and can slow feature rollouts. Second, regulatory friction for robotaxi expansion. If the agency is concerned about camera degradation and insufficient warnings, that cuts right into the story Tesla is trying to sell, that it can safely operate a scalable autonomous service. Third, narrative risk around the autonomy multiple. When regulators cite additional crashes and potential underreporting because of data labeling limitations, it can pressure analyst confidence in timelines. Takeaway. Watch for 2 things: whether Tesla publicly details any low-visibility mitigation update and how widely it's deployed, and whether NHTSA escalates to formal recall requests. Also watch the cadence of robotaxi expansion in Austin. Any pause or constraint would be interpreted as an autonomy roadmap delay. Story 2. A Cybertruck lawsuit adds more optics risk to the FSD conversation, and those headlines can compound investor anxiety when regulators are already leaning in. Hook. A new legal complaint alleges a Tesla Cybertruck, operating in a self-driving mode, failed to follow a turn on a Houston overpass and slammed into a barrier, with the driver seeking roughly $1 million in damages. Context. Tesla's driver assistance systems are classified as Level 2, meaning the human must supervise. But plaintiffs often argue the branding and marketing cause drivers to overtrust the system. This matters because lawsuits don't just create legal expense, they create a steady stream of negative clips and soundbites during a time when regulators are already scrutinizing the same product. Details. Reporting describes dashcam footage where the truck approaches a split and continues nearly straight into a concrete divider rather than following the roadway. The driver reportedly suffered injuries, while a 1-year-old in the back seat was not harmed. Separately, in commentary circulating around this case, Elon Musk disputed claims about system responsibility by pointing to logs suggesting the driver disengaged autopilot seconds before impact. That kind of fact pattern, what was engaged, when it disengaged, and why, is exactly what will be fought over. Impact. In the market, this doesn't change Tesla's quarterly deliveries. But it can influence sentiment, especially if media packages it as self-driving nearly drove off a bridge at the same time NHTSA is describing low-visibility failures. Takeaway. The investment question is not whether Tesla wins one lawsuit. It's whether a cluster of incidents pushes the company toward stricter driver monitoring, additional constraints on where and when FSD can run, or slower expansion of unsupervised operations. Story 3. Uber just made a huge robotaxi bet with Rivian, and the timeline is long, but the competitive signal is immediate. Hook. Uber says it will invest up to $1,250 million in Rivian tied to autonomy milestones, aiming to deploy 10,000 fully autonomous Rivian R2 vehicles starting in 2028. Context. Tesla wants to be a vertically integrated autonomy platform: vehicle, software, compute, and fleet economics. Uber is building the opposite, a marketplace that aggregates robotaxi supply from many operators. That creates a distribution channel that could reduce the need for any one player, including Tesla, to build its own consumer-facing ride-hailing app presence. Details. Uber plans an initial $300 million investment and the remainder through 2031, contingent on milestones. Deployment starts in San Francisco and Miami in 2028, with a goal of operating across 25 cities in the US, Canada, and Europe by the end of 2031. Uber and its fleet partners would buy 10,000 R2 Robotaxis, with an option for up to 40,000 more beginning in 2030. Waymo is referenced as the current scale leader with about 2,500 Robotaxis operating in several US cities. The story also notes Tesla has launched a small robotaxi service in Austin, with promises of rapid expansion. Impact. Tesla investors should think in two layers. 1. Uber is attempting to control demand aggregation, the rider relationship. If Uber succeeds, Tesla's robotaxi strategy would need to beat not only other autonomy stacks, but also a distribution incumbent with massive liquidity and pricing power. 2. Rivian plus Uber implies another well-funded pathway to scaled autonomy. The timeline starts 2028, but markets often discount competitive threats early, particularly if Tesla's regulatory path becomes more complex. Takeaway. Tesla's edge has to be speed to scale and unit economics. If regulatory scrutiny slows Tesla's rollout, it gives Uber's ecosystem partners more time to catch up. Story 4. Elon Musk says Tesla will keep buying NVIDIA chips at scale, while Tesla continues pushing its own AI silicon. Hook. Musk publicly reaffirmed that Tesla expects to continue ordering NVIDIA chips at scale, even as it develops its next-generation in-house AI chip, often referred to as AI5. Context. The autonomy business is a compute business. Training, simulation, and deployment all demand hardware. A key investor concern is whether Tesla can secure enough compute at reasonable cost while still improving per-vehicle inference efficiency. Details. Musk said the in-house AI5 chip is primarily optimized for edge compute, meaning running inference inside things like Optimus and robotaxi hardware, even if it can also be used for data center training. Meanwhile, NVIDIA remains critical for scaling compute capacity quickly. Impact. This is broadly supportive of Tesla's autonomy roadmap, but it also implies continued high capital intensity across compute, data centers, and silicon development, which can weigh on free cash flow in the near term. Takeaway. Watch how Tesla communicates capex and operating expense related to AI infrastructure. In a higher rate environment, markets are less forgiving of heavy spending without near-term monetization. Story 5. The macro tape is working against high beta growth stocks, and Tesla is trading like a high beta growth stock right now. Hook. Rising oil and gas prices tied to escalating Middle East conflict are driving a risk-off move across global markets, pressuring major tech names, including Tesla. Context. Tesla's fundamentals don't directly improve when oil spikes, even if EV adoption can benefit long-term. In the short run, an energy-driven inflation shock tends to raise bond yields and reduce the market's willingness to pay high multiples for future growth. Details. Pre-market reports showed Tesla down around 0.5% in the Magnificent Seven basket. Broader market commentary highlighted Brent crude surging above $114 a barrel, with European natural gas up sharply as well. Multiple reports also tie market weakness to central bank caution as inflation risks rise. Impact. For Tesla traders, this matters because Tesla tends to be more sensitive than the index to changes in yields and risk appetite. If yields stay elevated and markets keep pricing fewer rate cuts, Tesla's multiple can compress even if the company executes operationally. Takeaway. In the next few sessions, watch the 10-year yield trend and energy prices. If they stabilize, Tesla can trade back on company-specific catalysts. If they keep climbing, even good Tesla news may struggle to lift the stock. Let's wrap it up. Today's big themes are regulation risk on full self-driving, intensifying competition in robotaxis via the Uber, Rivian partnership, and a macro backdrop that's punishing high-growth equities. For tomorrow, keep an eye on any Tesla response or disclosure regarding NHTSA's information requests and low-visibility fixes, plus any incremental data points on robotaxi expansion in Austin. If you found this helpful, subscribe to Tesla Daily News podcast for your daily, investor-focused Tesla rundown, and follow along for the next episode.